Oh, can you see my PowerPoint?
Yes.
All right. I usually wait until about 25 of anyway. So, and if he's not here by then, I'll start my presentation.
Okay.
Awesome.
Okay, so can you hear me right now?
Yeah, we can hear you, Tom.
Okay, perfect. So Brittany's in the process of muting everybody, so this will be ready to go in about another second. Sorry for that. So it's good. We got a good crowd. It's gonna be great. I'll let you guys kick things off, and then we'll take over.
We figure we would do a Q&A after each strategy you do. Is that good?
Yeah, you know, Joe, it's your show. So I'm just here to fill in as like an expert, and then you guys can, happy to, let's go strategy. Then we'll talk about the strategy. Then we'll do a quick Q&A, and then we'll move on.
Okay. While we're waiting, when are the smalls going to have options?
The smalls will have options as soon as OCC has approved the smalls for options, but they haven't approved the settlement process for them because the OCC has never approved cash settled options yet for futures.
Brittany just muted you, or somebody, you're muted. There you go.
Yeah, sorry, Tom, I accidentally muted you.
No worries, Brett. No worries. So as soon as the OCC figures out how to clear cash settled futures options and code for it, we'll be live. We've already received approval, so we're just waiting on them.
And is the BTC smalls available yet?
Yeah. Yep. It launched on Monday. It traded today. It's /SCCX, and today it was up 54 cents, and it actually, it traded 350 contracts. It was a pretty tight market all day. It's good.
And what are these BTC smalls? What is that?
It's a crypto index that we just launched that it's made up of 17 different stocks that have a 0.85% correlation to digital assets or to Bitcoin, to the /MBT, which is the micro Bitcoin contract. And so instead of using actual digital assets, it uses 17 different equities because the regulators won't approve cash settled digital assets as an underlying for a futures product for us. So we had to use individual stocks. So we picked 17 stocks. So it has stocks like NVIDIA, Square, Riot, Mara, things like that.
Okay. Who's sharing their screen?
I have no idea who that is.
All right, I'll stay on just to mute people because it seems that people don't know how to mute themselves. So Tom, go for it.
Okay, well, if anybody speaks up, just leave it with James and Joe and myself, okay? Brett?
You got it. You got it.
Okay, perfect. All right, guys. Joe, James, your dime, your dance floor.
Jim, your mic is off.
Okay, here I am. My name is James C. Frank. I'm the organizer of this group, the Long Island Stock Traders Meetup Group. And Joe is my assistant organizer. And I'd like to thank him for arranging this meeting with Tom Sosnoff, co-founder of tastytrade. And I've met him personally a few times at the trade shows in Las Vegas and Florida. And he's very articulate and very well known around the world and giving advice and strategies in the option market. So really happy to have him here today and tonight. And so without further ado, here's Tom. Tom, it's all yours.
Thanks, James, and thanks, Joe, for having me, and thanks for everybody that's on today. So my goal, as always, with any kind of webinar that we do, is always to present as much content as we can in the shortest period of time, and to be as strategic as possible with respect to various takeaways. So I'm going to be using the tastyworks platform, which is our homegrown high frequency technology platform that supports all asset classes. So we're the only platform that supports stocks, options, futures options, and crypto right now, and virtually any strategy in any account type. So everything that we talk about today, you can do in any strategy on Tasty, no matter what kind of account you do, no matter how much money you have. So that's one of the neat things about us. So Joe, initially you asked me to come on today and you wanted to talk about specific strategies, because we like to do things, in kind of a very detailed and specific manner. Is there a specific strategy you want to talk about first? I think you mentioned in a email to me that you wanted to start with calendar spreads, but in case something's changed, because that was a month or two ago, I'm open to whatever you want to go for. Markets move, things have been busy, whatever you want to start with strategically, I'll start, and then we can take it from there and move to the next, from one category to the next.
We advertised the calendar spreads, so I'm pretty sure that's where that we advertised it as calendar spreads and Tom's favorite defined risk strategies.
Okay, so that's what you're going to get. And a couple things that we should just mention. Let me move some of these slides out of the way. So, of course, thanks for the great turnout today. And hang on one second. And what I would like to do is to talk just in general, for starters, about, we'll start with calendar spreads and then we'll work our way onto different strategies, but little nuances about calendar spreads. So first of all, and I need to put calendar spreads into perspective. So if you took all the different option strategies on an average day like today, I make probably about 100 trades a day. That's my average. And so on a day like today, if you ask how many calendar spreads did I do, the answer would be 0. So when I put it into perspective, it's generally a very small percentage of my trades. And the reason I'm telling you this is because I think it's important that you know what very active traders do and how they trade and what kind of different strategies they use. I would say that of all my trades, about 75 to 80% of them are options, and about 20% are futures and futures options, and the remaining, whatever it is, 5% are mostly crypto and trades built in there. The stock trades are less than 1%. Of those option trades that we make, because we don't do very many calendar spreads in the futures marketplace, futures options. So of the of the listed equity trades that we make, the number of counter spreads is probably less than a handful of percent. So I'm talking somewhere between 2, 3, or 4%. So when you look at counter spreads as a percentage of overall trades, that number is very small. I wanted to point that out because I don't want to add some importance to counter spreads that I don't think is there. The other side to it is, if you do incorporate counter spreads into your portfolio of strategies, it is very important to recognize that counter spreads are a good diversification, specifically a strategic diversification, and also a very nice diversification in periods, in underlyings that have low implied volatility. So the first thing you want to know about counter spreads is that they are a strategy that likes low implied volatility. And when I say low implied volatility, I don't mean that here, I'll look at spiders just as an example here. Spiders have a 22, 23% implied volatility. That's not what I mean by low implied volatility. When I say low implied volatility, I mean low IV rank. So on Tasty, one of the things we can do is we can look at high option volume. We can go to IVR and we can search by low. So if you're looking for stocks that have low IVR as potentially good counter spread trades, right here you can see GME. I mean, I know you might want to not want to trade a meme stock, but GME, AMC, NKLA, Mara, which is a crypto stock, MARA, which trades pretty actively, SLV, which is silver, BBBY. There's actually some decent stocks in here. Lucid, LCID, QS, Riot. These are all low IVR stocks. So let's take a look at something that's kind of active in here and just pick something like Amara, for example. So if I went back over to the trade page and I saw Amara, you'd see the IV rank here is 6.3. That's very low. That's a perfect candidate for a counter spread. The other thing with Mara that's important, and as is with any strategy, is you want high implied volatility. 15.3 million shares traded. That's high implied volatility in Mara. You might want to take a little look and see, hey, how does this stock done? And here's a little simple, small little chart here in the dailies. And this will show you kind of Mara's kind of mid-range. So if I looked at Mara and said, hey, how's it been? It's mid-range. Okay, so that's interesting. So what are you looking for in a counter spread? Low IV rank, high volume, some stock that's probably mid-range. That's cool. And then you're looking for something that has, this has high implied volatility, but low IV rank. That just means it's on the lower end of where implied volatility is. And then you want to just check the option volume for a second, just to make sure there's enough liquidity in the options. And here you can see, just today, 1,000 of these calls traded, 100, 1,000 of these calls. So there's plenty of option volume in Mara. Okay, so just to start off, low IV rank, high volume in the underlying, meaning it has lots of liquidity, high volume in the options, lots of liquidity, a stock that's been range bound, absolutely the case in Mara. And we know that this is tied into digital assets. Okay, next thing we're going to look for is we're going to say, when you do counter spreads, what are you essentially looking for? What's the perfect counter spread scenario? Well, ideally, you'd like to trade with skew. What that means is, if you're trading an index like SPY, you're doing counter spreads in SPY, you'd want to trade counter spreads mostly on the put side, because the skew is heavily, the option pricing skew is heavily weighted towards the downside. When you look at Mara, it's going to be different. The calls, the out-of-the-money calls that are $12 higher are $2.50, less than $1. So there's huge call skew. So in a stock like Mara, you'd want to trade in the direction of the skew. That's just a little trick with counter spreads. So if you're trading an index ETF or something, you want to trade them mostly on the put side. If you're trading a commodity or something that has a lot of call skew, like a digital asset, you want to trade these to the upside. It's because you're trying to take advantage of the rich skew. The next thing you want to do with counter spreads, and a lot of this stuff, by the way, because I'm glad a lot of people are on today, but a lot of this stuff, you'll never hear this or learn this from anybody else, because nobody thinks this way. This is just kind of the stuff we've been researching and developing for the last, almost 2 or 3 decades. So you won't hear this discussion about skew, and you won't hear this discussion, which is with counter spreads. What we do is we tend to look at the expected move. And the expected move in November, see, this is November expiration, which is 44 days out, which is perfect timing. You would not do October 9 days out. Forget it. It's not the optimal way to approach this. The optimal way to approach is to find your short option about 45 days out. And your short option here is 44 days out. So it's perfect. The expected move is $10.77 based on current implied volatility. The reason that's important is because when you build calendar spreads, you don't want to go outside of the expected move and you don't want to go too far inside of it. You want to trust the numbers. And the numbers in this case, which is taking a statistical approach or quantitative approach to strategic option trading, is you want to build something around the expected move. And in this case, you want to build it around the expected move to the upside. Again, the reason for doing that is because of the upside skew in here. So the fun thing about this little discussion that we're having is the stock is almost closed at $39. It's $38.96. Let's say $39. The expected move is almost $11. That takes us right up to the 50 strike, right? 39 plus 11 is 50. And the reason we're doing the upside is because that's where the skew is. So as a quick recap, low IV rank, high volume in the stock, shows lots of liquidity, high volume in the options. On the 50 strike today, 1,100 options traded, plenty of liquidity. This will be the option that we short. And you can see the market here is only 4 cents wide, 244, 248. We would click on the bid here to sell it. And that would be our short side of our calendar spread. We would then go out, these are no's. We would then go out to 72 days, which is the next month out. Could we go longer? Yeah, we could, but we probably don't want to. So we would go out to buy the 50 strike of December. Ideally, you would like to be in the 45.70 range, 45.72, 30.60, somewhere in that range, okay? And that's almost exactly where we are in this case. So I set up this calendar spread, and you can see this calendar spread costs $1.54. That's, and let's change the quantity here to 1, just so you can see something. Let me get rid of this slide, perfect. So the neat thing about this is, again, low IV rank, high volume, high option volume, high implied volatility, even though it has low IV rank, and a $10 expected move in November, and you always go to the front month expected move. You always go to the side of the call skew, which is what I did. You set the trade up, and then you take a quick look at the Greeks. How come we don't show probability of profit on this trade? Because we can't. And the reason we can't is because we don't know what implied volatility is going to be, so there's no fixed number. So we don't show you POP or P50. We are going to show you the delta on this trade, so this trade is slightly long. So if you do this one time, you are the equivalent of long 8 shares of MAR, which is tied to digital assets. So if you're not a digital asset bull and you're bearish on Bitcoin, you wouldn't do this trade. When you look at it and you weight it, beta weight it to the S&P 500, it comes up to 2.68 shares of S&P. The neat thing about Tasty is we show you this before you even place the trade. And obviously the buying power reduction is very cheap. It's only $1.54. Calendar spreads by definition are low risk, low reward, kind of around the range of 40 to 50 probability of profit, but without a max loss usually and without a max gain. They're somewhere in between. But there's a couple of other tricks to the trade I can teach you. When do you manage calendar spreads? Well, most people will manage calendar spreads somewhere on the low end of a 10%. So this is $1.54. 10% would be a 15-cent profit. That would be the extreme low end. And you mostly would only do that if you were doing it like in an SPX or on big index product where you're paying $10, $20, or $30 for the trade. In a stock like MARA, you'd probably manage this trade somewhere in the 25 to 40% profit range, somewhere in the 25 to 40% profit range. So somewhere in the range of, let's call it around 40 cents to maybe 75 cents, somewhere in that range. That would be your initial profit target on this trade. Now, let's do one other trick. Let's go back and let's take a look. Let's just, let's move, because on this platform, you can easily change the expiration. And let's do this. Now, what I did was I just clicked, as you can see here, this is the position we have on, no Ds. By clicking the minus arrow here, I took this trade back to October, November, same strikes. Because what if the underlying doesn't move? And we waited 1 month and the underlying, MAR in this case, does not go the way of your trade, not go the way you want it to. Okay? It just sits here. So when you do a counter spread and the stock's trading at 39, ideally you want the stock to go to 50, right? But in this case, the stock doesn't move. So where is this a month from now? And it's at 218. So you pay 54 cents, 154, it's now at 218. So you're still up 64 cents on the trade. That's not a bad trade for a stock that doesn't even accommodate you. But what would if we actually took the what would happen if we actually took this strike price and we moved this entire trade and we moved it down, for example, let's just see here. Oops, going the wrong way. Let's take it right down to 39. What if we hit a home run on this thing? And what I did right now is I moved my trade from October to November, which means I just moved time ahead by 1 month to see where this calendar spread would be. And it would be, oops, let me just see, because they don't have all the same strikes. Hold on. November. Hold on. Here it is, 39. So what happens here is this trade would go from 154 to 325. So the nice thing about this trade, the stock doesn't move, you make 65 cents. If the stock hits a home run for you, you can make $1.75. That's a pretty nice risk reward. Stock doesn't move, you make a little over 33%. You make 33 to 40% on the trade. Stock does move, you make over 110% on the trade. I mean, that goes if it goes to the perfect price. So there's lots of different ways you can mess with calendar spreads, and you can really learn about the different things that that you're doing. And that's just an example of. And I'm going to take you back to the start here for a second. Let me just clear this. And I'm going to take you back to the start here for a second. What I did was on the tastyworks platform, I went to my watch list. I searched by low IVR to find a stock that was reasonably low price, $39, with high implied volatility and low implied volatility rank, and 4 stars of liquidity, most importantly, with a reasonably low correlation to the SPYs. So it's a non-correlated trade with high volume, high option volume, like we show with 4-star liquidity here. I go to the trade page, I set up the calendar spread, I base it off upside skew and expected move, and then I set a trade up where if the stock doesn't move, I still make almost 40%. And if the stock does move to my perfect number, I make 110%. And in a worst case here, you probably lose about 50%. All right, I did that really fast, but I wanted to get in as much content as I can, and then we'll take a couple of questions. Joe, did that work for you?
Yes, you do have a question in there from, let's see, I think his name was Steve. Steve, do you want to ask it, or do you want me to just ask it?
No, you can unmute Steve, or you can ask it. You can ask it. Steve, you can unmute yourself and just ask the question if you want. Sure. Or you can ask it, Joe. If maybe it's.
He wants to know, how do you tell the skew again? He missed the skew part.
Okay, so Steve, every underlying has a different area where the market perceives the velocity of risk to be. So, for example, if you were trading in the S&P 500, where's the biggest risk, and where's the velocity of the biggest risk? And in the case of index products, it's to the downside. When you talk about commodities or meme stocks, the risk is always to the upside. When you talk about digital assets like Mara is, the risk is to the upside. The market doesn't worry about these stocks going down. They worry about the velocity of risk to the upside. So skew is how option traders adjust prices to account for velocity of risk. And in this case, you can look at any underlying and you can determine where the risk is. So I'll show you. Like, I'll go to QQQ here, all right? And oops, hold on. We're having not a great connection here. Let me see. Sometimes when you're on Zoom, things will slow down. Here, I'll just use SPY, for example. So I'll go to November, and the stock closed. Oops. Can you guys hear me? Can you hear me, Joe?
Yes.
Okay, because we're having some kind of a network issue. That is really weird. I'm having some kind of a connectivity issue, and I'm not exactly sure what it is. So I just lost my quotes for some reason. Sometimes when I'm on Zoom, it can happen, but as long as you guys can still hear. So I can't show you this, but I'll bring it back up in a couple seconds. But maybe they're just doing a download. They could be uploading new software this afternoon. I'm not really sure.
Let me take a look at mine.
They may just be uploading software right now, which is,
It's working on mine.
okay, then it may just be my office. Okay. So I apologize. There's a bunch of guys here.
They're doing a company wide update on people's computers at 4 p.m. So it could be that.
Oh, that's probably what it is. They probably took me offline. Great.
Yeah, that's it.
Okay, sorry, Britt. Okay, I didn't know that they. So
I didn't know until today either. So it's okay.
All right, Joe. That's just an internal thing at Tasty. They're just. But don't worry about it. We'll still, as long as we can talk, that's all that's important. But I will give you some examples of skew in a little bit when we come back online. But the velocity of risk determines how option prices have been set. And all of this changed in 1987 when the market crashed. So prior to 1987, calls and puts equidistant away from the at-the-money strike were the same price. After 1987, calls and puts changed based on where the perceived velocity of risk was. Okay? Do you have any other questions, Joe?
Yes. Another person asking about skew, but you answered that. Let's see. Mitch, do you want to ask your question directly? And
Hey.
Hey, Mitch, how are you?
Hey, Tom. You had mentioned when you were going through the criteria that the price of the underlying should be, and I think you said, quote unquote, sort of relatively low priced. I guess that reduces volatility. But do you have sort of a suggestion about, a range 30 to 75? Like, what are you thinking there?
No. I don't actually care if the price is low. I think if you're learning how to trade calendar spreads and you're learning how to use these as an effective tool inside of your strategic toolbox, then you might want to start with some lower priced underlyings, just because that means the counter spreads will be lower priced. The problem with low price counter spreads is that they generally don't move much, so they're very frustrating. And I'm totally comfortable with you doing counter spreads in like Amazon if you want, or the SPX, or or the QQQ, or the spiders. I don't care if it's an expensive underlying. I think though, for the purposes of getting started, you might want to find a high implied volatility, low priced underlying like Amara, just because you can get more bang for your buck and you can learn a little bit more quicker. But no, normally I don't care about the underlying price.
Okay. Joe, I think it might be a good idea if anyone has a question to unmute him or herself, and then after the question's finished, mute themselves. How about that idea?
yeah, that's what we're doing.
Are you doing that? Okay.
Yeah. The next question is Pana. Do you want to ask your question, or do you want me to read it for you? All right. The question is, do you have a scanner for call or put skew on your platform, just like scanning for high options and volume and IVR scan on Tasty?
It's a great question, Hannah, but no, we don't scan for skew. And, you know, I've never thought about actually adding a scan for skew, but the more I think about it, I kind of like that idea. It's something that we've always taken for granted because we just look at the prices and, you know, you can figure it out on your own really quickly. But I think the important thing for calendar spreads specifically is the reason I talk about skew as it applies to calendar spreads is because it's actually very helpful with making a directional decision with respect to that calendar spread. If you are bearish, for example, on digital assets, you would not do a call calendar spread in Mara. So you have to also put some of your own, you know, subjectivity into the market call. But, you know, I just suggested that because the thing that's important to us is looking at expected move and choosing the strike based on the expected move and then not fading the skew. So going into the skew, basically you're selling the front month heavy skew.
Okay. Gadhi, G-A-D-H-I. I'm sure I'm destroying your name. Would you like to ask your question?
Yes, hi, can you hear me?
Yes, I can hear you. Thanks.
So my question is, at what point would you, like when you take the trade off, would you take one side off? Do you take both sides off at the same time? And kind of what's your, other than kind of percent profit?
So Gotti, what goes on as a spread comes off as a spread. There's absolutely no reason to leg. So calendar spreads are a strange little bird in the sense that they are, like I said earlier, they're low risk, low reward trades, generally speaking. And on a trade like that, it makes absolutely no sense to leg out of the trade. So you put it on as a single trade and you take it off as a single trade. And the nice thing about calendars is you can do them in any account type. They have very low buying power reduction, so they're very inexpensive to trade because it's only the cost of the trade. And there's no reason to ever leg in and out of them. What you may do with calendar spreads is you may, over time, decide that you don't want to have the same strike. You know, like in other words, you'll sell the front month strike short, you'll buy the back month. You can't do it the other way around as a retail investor because the regulators don't look at that as a hedge position. So you have to buy the back month and sell the front month. But ultimately, if you wanted to change one of the strikes and diagonalize the position, we would have no issue with that.
My second question is, if the stock went above the strike of the short option, could you know, is that a benefit, or could you lose on the trade as a result of that if the stock moved up very quickly beyond the strike of the short position? Of
course you could lose if the stock went far enough up, but if it goes just up, I just showed you a minute ago looking at that Mara trade. If the stock stays unchanged and stays $12 below the strike, then the trade was still a winner. So if the stock would go $12 above the strike, it would have the same profit loss profile. So it would still be a winner. But if it went $30 above the strike, no, it'd be a loser.
Great.
Calendar spreads, it's a great question because calendar spreads, just so everybody on this call, everybody on this webinar gets it. Calendar spreads are not really an adjustable trade. They are pretty much, you know, one and done, and they're a set it and forget it trade but you can watch them and you can take profits, or, you know, you can take losses, you can take profits, but they are not a trade that you generally adjust or tweak. They are a trade that you can make money on if the underlying goes in the direction you want it to, or you can make money on the trade if volatility increases. There's two ways to make money.
Okay. Amos, would you like to ask your question? Amos? That's okay. He's saying to me to ask it for him. Since Tom only does calendar spreads 2% of the time and we learn about them, they seem like a godsend. When do we use them, and when is something else a better tool?
So you would use calendar spreads when you want a low buying power. So you want a very capital efficient trade, and the IVR on the liquid underlying that you want to trade is very low. So when the implied volatility of that underlying is low relative to itself, which is measured by IV rank up here, then that's when you would use calendar spreads. And you want a low risk, low reward directional trade. The reason, Joe, that I don't use calendar spreads that much is because they are very slow moving. And so calendar spreads to me get to be a little frustrating. I don't need instant gratification, but I need some gratification. So
I think when we put this together, that was when IV was like really low,
yeah,
during the
I think it
summertime.
probably was. Yeah.
Yeah.
Listen, I don't hate counter spreads. I've been trading them for 40 years. I just don't, I just don't do them that much because in today's world, I prefer high implied volatility that's going to contract than instead of low implied volatility that may expand. But I think it's a great discussion to have. Nobody has this kind of an in-depth discussion on calendar spreads. And it looks like, hang on, if our technology's back, it is.
There we go.
So when I look at, for example, the Qs here, they closed at 360 just about. So if I went to 350, you can see the puts here are $7 and let's call them $7.75, $10 out of the money. If I go from 360 to 370, the calls are $5.34. So the puts are 50% more than the calls. That's put skew. In Mara, there was call skew. In the Qs, there's put skew. So to that person, I think it was Steve who asked that question earlier, that's what put skew is. When equidistant away the puts and the calls, the puts are 50% more expensive than the calls. And that's in the Qs. But if you looked at something that, where the risk was to the upside, it would all be on the call, it would all be on the call side.
Does the expected move automatically compensate for that?
No, the expected move does not compensate for that because the expected move is just based on an at the money volatility smile.
When I joined, it said that. Oh shit.
That's plus or minus.
I'd like to make a comment, Joe. I think the calendar spreads would be an ideal type of option trading for novice traders and an opportune moment maybe to start learning how to trade options. So it's conservative and it's low risk, and I think it's a great idea for the novice traders to start in this kind of scenario.
It is, and I'm going to show you something else here, which is cool about Tasty, Jim. That's fun. So let's say, for example, you wanted to trade a calendar spread in the Qs. And so I'm going to look at the expected move to November, which is $21. And so I'm going to take the 360 number and I'm going to just drop it by $20 and take us down to the 340 strike. Okay. I'm just going to go $20 lower because the skew is to the downside. And I'm going to put hit the bid on the sell side of the November 340 puts. Okay. Then I'm going to go out to December and I'm going to buy the December 340 puts. This is a classic calendar spread. Now, what I'm going to show you is on this calendar spread, I'm going to reduce my quantity to 1, and the delta on this trade is minus 367, and the S&P delta is about 3. So this is a tiny little short position. It costs $275 to do. Let's just say, for example, you wanted to make this trade, but you didn't quite want to be this short. You want it to be a little bit longer. The cool thing about Tasty is we don't actually care what strike you sell. So instead of selling the 340, you can keep your long at the December 340, but you can move your short put up to the November 342 and diagonalize this trade by just dragging it a strike or two higher. This reduces your delta. Here, I'll move it one more. This reduces your delta by 2/3. So from 3 something down to -1. This is almost a completely delta neutral trade. Or if I move it one more, it is delta neutral, exactly flat. So I'm selling the 344 in the front month and buying the 340 in the back month. This is a completely neutral diagonal spread where you're collecting some pretty decent front month premium. You're only, in this case, paying $1.92 for this trade, we've added a different element of risk to it because we've embedded a short put spread inside of this calendar spread. So we call this a put diagonal. But the beautiful thing about this platform is you can do that and you don't have to change anything else. Like it's all just drag and drop and that's it. Or drag and stop and that's it. And on the other hand, if you wanted to make this trade back to a calendar, just drag it back to there. That's a straight calendar. And if you wanted to make this trade a little bit shorter, you just drag these puts down to here. You'll pay a little more for it, but you know, you have a bigger window. If you wanted to make this trade shorter, now you're short 7 deltas. And that's the beauty of the tastyworks platform. You can mess with it. You can change the quantities, you can change the strikes by just dragging, and you can turn a calendar spread into a diagonal spread. And just like Jim said a minute ago, you can learn a lot more about trading by doing all this stuff.
How come your software doesn't show the expected move, which to me is a really big feature on tastyworks?
What do you mean? It's right here.
No. On mine, I have a brown line down the middle. Like if you open up one of the.
Oh, I have that. I just turned it off.
Oh, you turn it off. To me, that's one of the biggest features I love about it.
Yeah, I know a lot of people like it. It drives me a little crazy.
All right, let's see. We got another question. When you manage your 25 to 40% profit, are you closing the position as the short dated option loses value prior to expiration?
Okay, so here's a good question. And the reason it's a good question is because we treat every single strategy the same. So if you put this trade on where you sell November and buy December right now, there's 44 days to go until November expiration. We are going to close this trade by 21 days. So the longest I'm going to hold this trade is 23 or 24 days. That's the longest I'm going to hold this trade. Because we close or roll every trade with 21 DTE. Because in our models, that is the optimal time to close or roll. So at 21 DTE, that's what we do. So the answer to this question is win, lose, or draw. When this number here gets to 21 DTE, we are closing, rolling, or doing something else with this trade, but we're not keeping it on its current state.
Tom, is that 21 days before expiration? Like 20...
That's 21 days before expiration, yes.
Thank you.
Chris Parker.
Hey, Tom, can you hear me?
Yeah, hey, Chris.
Hey, so I know you're not a believer in technicals. So when you take a trade, whether it's a calendar spread or say like a vertical spread or something like that, do you base direction entirely off skew, or do you take other like measures into account?
I base direction. My directional bets have nothing to do with skew. I base direction completely on a combination of just my own thought, like I'm making an assessment myself, and I'm doing that based on extreme pricing and what I think the overall market's going to do. I have no other basis. See, I believe direction, Chris, is completely random. And so I will bet, I will put way more money on the fact that I don't know anything than on the fact that I do know something. So I will bet on the expected move, and I will bet on variations of that expected move. So let me give you an example. So in the Qs right now, the implied volatility on a daily basis right here, you can see it's right around 25. A 19% implied volatility is about a 1% move. So at 25, it's about 1.25% move. That is the expected daily high to low move. That's just the way option pricing models work. 19.1% implied volatility is a 1% move. So you can multiply out and kind of extrapolate a daily expected move. So what I know is going to happen in this stock is that high to low right now on a $350 stock is going to be somewhere around 1.25%. So you're talking probably somewhere around $4.20 in that range, a little over $4, maybe somewhere between $4 and $4.50 per day. And I will base my subjective or objective directional opinion just based on that daily expected move, and that's it. I don't claim to know anything. Yeah, technical analysis. I base nothing on technical analysis. I base nothing on fundamental analysis. It's all on just, kind of how the market's doing and what I expect to happen.
Looks like we're almost out of time, but I kind of wanted you to do another, like, what is your favorite strategy for defined risk?
For defined risk?
Yes. I know you're a big strangle guy, but.
Yeah, so for defined risk trades, Joe, I mean, there's a bunch of, obviously we can get into some, fairly complex things, but I think for defined risk, and you may or may not love this idea. I like high implied volatility rank, and this to me is high enough, but if I went, I would go to the same thing, but instead of searching from low to high, I'd go from high to low and look at some of these stocks. And let's just say, for example, right now, I wanted to do something like in Baba, because this is a stock I have a lot of positions on in. It's a stock that I actively trade. IV rank is 85.6. It's a $144 stock. It's a stock that I feel is pretty grossly oversold. So I'm going to go to Baba, and here's the high IV rank. Here's huge volume in here, 15 million shares. Here is November options, same thing. We're going to take a look at the expected move in November, same exact process. It's $20, high implied volatility, plenty of option buy, $20 expected move, plenty of high volatility, lots to do in here. I feel like this stock is very oversold. That's completely subjective. My opinion, I'm a little bullish on China. So you can see these are my current, these are some of my current Baba positions over here. And what I would like to do in this stock is to sell a put credit spread, because that would be my favorite defined risk approach. And what I'd like to do is I'd like to go 45 days out. This is 44. And I'd like to collect closest to about a little over 1/3 the width of the strikes. So I'm going to just start on the 33. Usually it's around the 35 delta. So I'm going to look at the 35-30 put spread. And that's just about, it's a little under 1/3 the width of the strikes. So I would be good with this, but I may just look at the $10 wide, which is exactly 1/3 the width of the strikes. So the 130, 140, 335 is 1/3 the width of a $10 wide put spread. This is the one I would probably choose. I like wider spreads, higher probability of profit. In this case, I'm kind of right below where the current market is. The P50 is, the POP is about 53%. It's a little low for me, but I'm right at the money. The P50, which is the probability of making 50 max profit, is 75%. Now, when you're doing credit spreads, although the expected move in the next month is $20, if I went $20 out of the money, okay, I'd have to go to the 125 strike, and that's a little bit too cheap for me, less than 20% of the width of strikes. And if I went $10 wide, it would only be 15% of the width of strikes. I'm going to go back up because I'm a little bit directional here and recognizing, okay, I'm taking a shot, but this would be my credit spread of choice on the put side. And again, the similar characteristics apply for the calendar spread, except the calendar spread, I want low IV rank, and in a credit spread, I want high IV rank. So high IV rank, some decent, in this case, the skew is about unchanged. It's no put or call skew. High volume, plenty of option volume across the board, exactly 1/3 the width of the strikes. It meets my directional bet. A one lot here is about 12 deltas, which is fine. And I understand, kind of my risk reward. So let's think about this trade for a second. 335 minus 140, it takes you down to little over 135. So the probability of profit in this trade is going to be just, it says here 53. It's actually going to be a little closer to probably, 58, 59. And that's the kind of trade I would do. I'd manage this trade the same way, 21 days DTE. And what I also like to do is, and the nice thing about Tasty is, if you like this put spread, I would probably add to this a call credit spread and turn it into a really weird iron condor, because the call credit spread requires no additional capital. So because I'm selling a 40 delta, I'd probably go down, let's just call it maybe a 15, 17 delta call, something where I can get at least collect a little bit more money. So I could take my 335 up to 385 and add another 50 cents this trade, or I can go $10 wide and add another 90 cents this trade, which changes the metrics, changes my probability distribution, and it changes my return on capital, and I don't have to add any more capital. So if I get rid of this trade here, the capital is going to be 335 minus the $10, or the equivalent of, let's call it, $665. If I add this call spread to the trade, I'm in $10 wide, I'm going to pick up another $90. So I'm going to $90 in credit. I'm going to reduce the capital required from 665 down to 575. So it's going to change that as well. So that's interesting. And our research shows that if you have the ability to add a call spread to a short put spread, you should do it. But in this case, I kept the position very long by adding a way far out of the money call spread. But to answer your original question, Joe, if I was bearish, I'd probably sell a call spread in here. But I'm bullish. I like the fact that the stock is oversold. I like the fact that IV rank is really high. Oversold is completely subjective again. And I like the fact that I can add a call spread to this if I want to for no additional money. And that's what I consider the future of self-directed finance to be. It's going to be about capital efficiency. It's going to be about strategy. It's going to be about using every product that's available to you, everything. No limitations.
Okay. We have a couple of questions.
Fire away.
What does Tom mean by width of the, that's actually is one before that. Is there a way of scanning for that 1/3 of the width?
There is not. Not yet, at least. We're considering, it's on the list. It's been suggested to us before. The devs have it on their build list. We just haven't done it yet.
But basically, if you start at 35 delta, when you're looking at something, you can get to 1/3 the width.
It's almost always going to be around 1/3 the width of strikes. When you start at 35 delta, it's almost always going to be very symmetrical in that regard.
And what does Tom mean by width of the strike?
130 to 140 is $10 wide. That's what we call width of the strikes. And our goal is always to look for about 1/3 the width of the strikes when you're collecting a credit. And the reason for that is if you go over 50% of the width of the strikes, you are going to have a probability of success that's below 50%. And our goal is to always have a probability of success that's above 50%. So you don't want to go too wide because you don't want to have too low. You don't want to have too small a credit and too much risk. The perfect sweet spot for risk reward is about 1/3 the width of strikes.
Pana has a couple of questions. Pana, would you like to ask your question?
Hello, can you hear me?
Yes.
We can. Hi, Hannah.
Okay, hello. So I was the one asking about scanning for the put skew or the call skew, because just lately I noticed there was a change in Tesla. There used to be a call skew for a long time, and these days we are getting a put skew. And actually today I placed a trade with a broken wing butterfly, but I thought it could be interesting to see on a longer term when a trend is changing in the skew, and it's so hard to catch these things by eyes.
You know what, Pamela, you're right. And it is hard to catch those things by eyes. And I never thought about that before, to talk about the to scan for a change in skew. And I don't think it's a very difficult thing to build. And I've already made a note of it that while we're sitting here talking. So I'm going to send it over to our devs and see what they can do. I like the idea.
Thank you. And so how would you change your strategy when you notice something like this?
If it was a directional play that I wanted to make, it may change the actual strategy that I do, but I don't think it would change my idea of whether or not I wanted to trade that underlying. So, you know, I mean, if I want to trade a certain underlying, I'll trade it no matter what, but I will use different strategies to take advantage of skew. Like, for example, the best skew trade we have is a Jade Lizard, because if you have put skew, you'd like to sell the put and sell a call spread, because that's the beauty of a Jade Lizard. It works perfect. If you're doing an iron condor, the skew really doesn't matter. If you're doing a strangle, the skew generally doesn't matter. But if you're selling something like a naked call or a naked put, skew matters, because you'd rather sell into high skew. So I just think that and things with, like, for example, where you're doing something that's horizontal, like the calendar spread we started talking about, I think skew really helps when you can sell the rich skew. So I think for certain strategies, skew does help. No question about it.
Okay, thank you.
Sure.
Rose, would you like to ask a question?
Oh, thank you. Tom, I go back to that Bob's scenario. That market is skewed on the downside, I guess, but you see it upside.
Hold on, Rose. I didn't understand that. Say it again.
Okay, so with the example you put up for Bob, you said that you're bullish on Chinese stock, and the market obviously had a skew on downside. I'm trying to figure out how to figure out the skew.
Oh, okay. So the easiest way to just kind of look at skew here is like to say, so Bob is let's just call it $145 stock, right? And it's 144 actually. So the at the money is they're kind of the same. Let's go $20 away. So we'll go down to the 125. That's $20 away on the put side, and we'll go up to the 165 on the call side. Okay. Now it's a little bit off because the stock's a little under 140. It's 144, not 145. But you can see the 125 puts are 460, and the 165 calls are 375. So in this particular stock, there's a tiny bit of put skew, not a lot, but there's a tiny bit of put skew. If we went $30 away, you can see here a little bit better. The puts are a little bit richer than the calls.
Because it's cost more.
Yeah, because they cost more, because these are $3 and these are only $2.20. So there's a little bit of put skew in Bob.
Okay, so you believe this thing will maybe go up, so therefore when you put your put spread, you put it closer to the money, but you put further away from the money when you put your call spread. Is that the reason?
You mean, are you talking about with respect to skew?
Yeah, when you put it in
the reason I moved my put spread closer to the at the money here was simply because I was being more directional. If I was non-directional, okay, there's a couple things here. If I was going to trade BABA and I really wanted to get long BABA, my preference would be to sell a 15 or 17 delta put naked, because that's the best risk reward for my money if I'm bullish, because I'm selling a far out of the money put with an 85 to 90% chance of success. And this makes the most sense to me, just to sell this naked put. But Joe asked for a defined risk trade. So to get a defined risk trade that meets my criteria, I like the 140, 130 put spread short. That was the whole reason. That's not necessarily what my play would be, but my play would be something a lot more aggressive.
Actually, that looks like a Tony Zhang trade. That's because it's so close to the 40 delta.
Yeah, so a guy like Tony likes to do things that are very close to the at the money to open. I only care about the credit. If I could get a bigger credit, I would have done this trade. You know, I just wanted more than 26%.
All right, let's see.
Although you said you have, sorry, this is me again. Just to, you said that you don't have beliefs that you will be right or wrong, but in this particular case, you believe the downside will not exceed the upside.
No, what I said was, I don't know anything. I have beliefs. I just know that I don't know if they're going to be correct. There's a big difference. So Rose, I'm very opinionated on the market and I'm very opinionated directionally, but I've been doing this a long time and I recognize that I'm not fooling myself or my ego or anything else to think that I actually know what's going to happen. So I was answering the question before when he said, are you looking at technical analysis, fundamental analysis? Are you looking at something macro? And the answer is no. What I'm looking at in this case is, I've been trading a lot of Chinese stocks and they've been very, very weak. I think they're grossly oversold. And it's just an opinion. It's completely subjective. I have no basis other than it's my own risk capital. That's it.
The other thing I guess people should know is that you are a contrarian trader.
I am absolutely a contrarian. And absolutely.
Amos, we'll come back to you. Hello, this is from Andrew. Hello, Tom. May I know how to avoid, he's writing VI crush, but I believe he means IV crush scenario, and how much percentage do you usually cut loss when the direction is not going as you expected? Thank you. Your presentation is amazing. Thanks a lot.
Thanks. So Joe, just read the first line again. How do you know what was the first thing? How do you know the IV crush?
He wrote VI, but I think he probably means IV crush.
So, okay. So the question here is, how do you avoid an IV crush, right?
Yes.
Okay. So if you're worrying about avoiding an IV crush, that means you have been buying options. So that's something very different than what we've discussed today on this webinar. So all we talked about in this webinar was to find risk ways to sell options. And we did not talk about buying options. If you're buying options, you are not going to buy options in a stock like BABA because with an 85 IV rank, you are buying options at their most expensive price, and you probably don't want to do it. You'd like to buy options when the IV rank is quite low. So how do you avoid an IV crush? You don't buy options with high IV rank. That's number one. Number two is when you're buying options, if you want to avoid an IV crush, it's strongly recommended that you have a very short-term perspective on things because you generally can't, options, time value is going to catch you at some point. So what I would buy options with an expectation of at least understanding what the expected move is. So for example, I'll clear out BABA. And if you're going to buy an option in BABA, the expected move between now and November is about $20. It's 19.94. That move, that's totally accurate based on all these active at the money options. So what I would do in this case is if I was buying an option, I wouldn't go much more than $10 out of the money, $5 or $10 out of the money, because I know I need to make some money. And the most this stock's going to probably go to, 85% of the time is only going to be $20 higher. So it's currently trading at 144. That puts 165 at the high. That means if I'm going to buy anything, it's going to be 145, 150, or 155s. And I'm going to do it when the IV rank is low. And I'm going to look for a reasonable profit based on whatever that option price is that I buy. And that may be anywhere between 25 and 50%.
Okay. Amos, did you want to ask a question? Okay, he's asking me to ask it. He's saying he's lost on how to use the width of the strike and how to you implement the 1/3 rule.
Sure, Amos, that's a good question. So here is a blank screen, okay? And it's Alibaba. So it's a very liquid underlying. It has $5 wide strikes. So if I wanted to sell a call spread here, let's say I want to do one that's $5 wide. That's the narrowest you can do. I could sell the 155s. Oops, I'm sorry. I'm doing the wrong thing. I can sell the 155s. I can buy the 160s. That's the smallest call spread I can sell. Those strikes are $5 wide. 155 to 160 is $5 wide. If I wanted to make it $10 wide, 155, 165, I just drag it. That's $10 wide. So 1/3 the width of the strikes here is about $3.35. 1/3 of the width strikes here is about $1.67. If I went to something like spiders, it's a little easier. Open up November. These are dollar wide strikes. So if I went to 440 and sold them, I could buy the 443s. That's $3 wide, and I want to collect $1. Does that make sense, Amos? That's the width of the strikes.
I think you should show them where the max loss and the because I use the profit and the loss thing. I subtract those two numbers.
So yes, it's down here in this Greek line, but if that's hard to see, if you sell a 440 call and you buy a 443 call and you collect 1/3 the width of the strikes, which let's just say it's $1. I'll make this really simple. So let's say it's $1. Then you are risking, in this case, $2 to make $1. So you're saying, well, why would I ever risk $2 to make $1? And the answer is because I'm going to have a 67% probability of profit. Math works out perfect. If I was collecting $1.50, then I'm risking one to make one. I'm risking one to make one with a 50-50 probability of success. If I collect $2, okay, then I'm risking one to make two. So I'm only going to have a 33% probability of profit. Hopefully that makes sense.
Yeah, the way I usually do it is I I divide the max profit into the max loss, and that's how I know.
Sure, same thing. Yep.
Right, it's the same thing. It's just easier to do.
Exact same thing.
Yeah. In my brain. Let's see. Mitch, would you like to ask your question?
Sure. Tom, earlier when you were talking about when you were comparing looking at the skew and you were looking at the prices of the calls and the equivalent price, the puts, and I thought you said something about sort of the difference, like, I don't know, like something about like 50% or something like that. Is that what you said before?
Yeah. When you look at an index like the spiders, the diamonds, the Qs, IWM, the puts are always going to be 50% more expensive than the calls, equidistant away from the at-the-money strike. So if XYZ is an index ETF and it's trading at $100, the puts that are $10 away are going to be 50% more expensive than the calls trading $10 away.
Great. Thanks so much.
Sure. Anytime, Mitch. So Joe, just to give everybody a little update. So my email is tom@tastytrade.com. Just tom@tastytrade.com. If anybody has any questions or anybody has any, wants any follow-up or anything like that, happy to answer any questions anybody has. Happy to give you more information on Tasty Trade. We broadcast 10 hours a day live now on the Tasty Trade network. Right now, we're actually just wrapping up our last live show of the night with Victor and Ryan. And then obviously there's the tastyworks platform, which is, I think, the top rated brokerage platform in America right now. So you should check it out.
Henry, you're asking a question about straddles. Tony Batista is actually going to talk about straddles and strangles for trading earnings in December.
Oh, that's great. The battle be great.
Amos does higher skew tell Tom anything about the probability direction? Now on the
No.
bottom where it says pop and P50, that's telling you, go ahead, I'm sorry, Tom.
The skew is not directional, does not give you any direction. But not to confuse skew with SKEW, which is an indicator called skew. So Amos, just to make sure you don't get confused. So when we talk about option pricing skew, that's what we're talking about tonight. But there is also an indicator called skew, which is SKEW. SKEW is currently trading at 131. That is the CBOE skew index, which measures tail risk. So it's a fear measure of tail risk. It has nothing to do with the discussion we were having today.
I guess real quick is can you explain, I mean, these are my go-to indicators is the POP and the P50. Can you explain that, how that works for people?
Well, we added everything into one simple look on the platform. And the reason we did that is because people get confused, and we've built technology in the past that's a little heavy, bloated, slow, that kind of thing. We wanted Tasty to be really simple and straightforward, so everything's on one page. The POP is the probability of making 1 penny at expiration. The P50 is a Monte Carlo simulation that takes a look at thousands of different samples of the same exact trade, and it gives you the probability of making 50% of max profit on that particular strategy. We're the only platform that offers you P50 and POP side by side. So they're just two really helpful quantitative measures that are just based on the current option pricing that's in front of you.
Okay. I think that's it. I got you on overtime, Tom.
You got me on overtime, and I got another webinar I promised to do tonight, so I'm going to run, Joe. And Jim, thanks so much to everybody listening. You know, it's been great. I've really enjoyed it. I love coming on these. I'll do them anytime, Joe. I mean, I'm always available in the afternoon. Happy to do it anytime. You guys know, Tony or myself will do it. This is how we, build up our business. This is how we make friends, connections. Again, my email is tom@tastytrade. Please feel free to reach out, and good luck this week. Talk to you guys.
Thank you, Tom, and everybody stay on. Everybody stay on.
See you guys.
We also have Liz and Jenny in the next month.
Oh, awesome. They're great. They're
and Tom, disconnect your share screen, please, Tom. And Tom, thank you very much for your input. Really appreciate it.
Thank you so much, Tom. Thanks, Brittany.
And hold on, everybody. I just want to go over the schedule. Just take another minute. Okay. All right, I got the schedule now. We have either Tom or his colleague in December also. And funny, I don't have a listed here. Actually, November 17th. Joe, is that right? November 17th is, November 17th is next month. And Tom,
no, November 17th is not Tom. November 17th is going to be Liz and Jenny.
Batista or Jennings? Oh, all right, I'll fix it up. I'll fix it up. I'll talk to you later. And next meeting is October 20th. Stephanie Kammerman, the stock whisperer. That'll be a very interesting meeting. Hope you all attend. And go on the website and you'll see all the meetings listed there, okay? And thanks for attending. Joe, thank you very much for hosting the meeting. Any questions or comments at this time? Joe, do you want to say anything else? Otherwise, we'll just end it.
I don't know if anybody has any questions.
Okay. That ends it. Thank you, people. Enjoy.
All right. Thanks, everybody, for coming.
Right. Bye.
All right. Bye.